Activision Blizzard down more than 7% on reports the company is planning hundreds of job cuts. Activision is set to report earnings after the bell tomorrow. Meantime, Electronic Arts was up more than 2% in today's session, but shares sliding throughout the day to end down. It did get an upgrade to buy from neutral at Bank of America Merrill Lynch. This after the company saying its Fortnite competitor entitled Apex Legends gained 10 million players in 72 hours. It was up last week on the back of that story, which I think came out on Friday. Mike, in terms of the movement we're seeing here, clearly this has been a big growth area, subsector, sounding like it's peaked out a little bit.
I mean, they look like broken growth stocks, I mean, based on how far they are from their highs. And I think also the latest news flow reinforces the old idea that it was a very hit-driven business, which for a long time it seemed like they didn't trade that way, and the economics of them were kind of working in favor of the publishers. So it does seem as if it's a little more of a name-by-name story now, as opposed to, hey, everyone's spending their eyeball hours on video games, and that's where you should just own these stocks.
Do you see, Paul, the action in these names as an overreaction or not?
You just look at the reaction of Electronic Arts last week. They had earnings on Wednesday, and the stock was down to 72 from the high 90s to 72 on the earnings. On the earnings call, they mentioned this Apex game and the release of the Apex game, and then the stock didn't react at all. There's no positive reaction. 2 days later, the stock's back up above where it was when it reported. So I think it just goes to show there's more of the broader market in general, just very reactive nature rather than trading on momentum rather than focusing on the fundamentals.
To that point, if all of the market is to be more reactive like that, which it might not be, but if it is, how are we shaping up for the rest of the year? Earnings has come down significantly, the guidance. Are we not looking ahead enough to the coming quarters where we're going to start to see earnings growth soften?
It's interesting you bring that up. The guidance spread this quarter is one of the weakest we've seen of the bull market. But when you look back at prior periods when the companies lower guidance by this degree, the performance the following earnings season and up to the following earnings season is actually better than average because, again, it's all about expectations and at the margin. And when companies set the bar low, it's easier to beat.
You know, there's a bull case that it feels and looks a lot like 2016. Which basically had a December Fed hike, then the Fed turned dovish, and earnings estimates kept trailing off into the middle of 2016, but the market kind of rebuilt a lot of the value lost from the previous year. So a lot different as well. Not going to try to say it's a replay, but it's interesting that the market can do okay even when earnings are kind of eroding below.
How do valuations compare then?
Very similar, actually, because you got up to about 17 times forward earnings in the middle of 2016. You had the Brexit hiccup, and then, of course, the election kind of put everything on its head. But up until that point, you had actually done fine, even though you had an earnings recession. The caveat is we're much earlier in an earnings downturn now than we were at this point in 2016, if that's what we're going to get.
The other similarity, of course, is a Brexit hiccup to come this year. Not quite sure what shape it will be.